Hi, I'm Jared Nelson, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week, we're going to look at the big story that's been driving some significant changes in the markets. That story is about rising interest rates and higher rates of inflation that may be coming down the track. Stocks that have driven U.S. equity indices higher over the past year were the hardest hit. The NASDAQ composite indices finished February with a loss of negative 4.9% on the week, and the NASDAQ 100 effectively erased all of its year-to-date gains as well. Meanwhile, the VIX index, which measures levels of fear or risk appetite among investors, jumped higher by almost 27%, though it did finish last week of February below its recent highs. So, just what are the market's concerns, and why have they spooked investors now? The market's biggest concern is that inflation will creep into the U.S. economy as it reopens for business. Inflation is an imbalance between supply and demand, and is often described as too much money chasing too few goods and services. There is plenty of money in the U.S. economy thanks to central bank interest rates being held close to zero, and the Fed pumping money into the securities markets through its QE program, under which it prints fresh cash to buy bonds and ETFs. On top of that, the federal government has stimulated the economy with direct payments to consumers and businesses, and indeed, Congress has just approved another stimulus package worth $1.9 trillion. As of yet, there's little hard evidence that excessive inflation is creeping into the U.S. economy. However, markets are not concerned with lagging or backwards-looking indicators, which most inflation measures are. Instead, they are forward-looking. The bond markets, in particular, are concerned about inflation, and in our first chart, we can see the 5-year break-even inflation rate. This is a measure of expected inflation rates over the next 5 years in the USA. You can think of it as what the bond market is pricing in. As you can see, that expected rate of inflation has been climbing steadily over the last year and continues to do so. There is no guarantee that this expected inflation will materialize in the economy, but if it did, then the Federal Reserve would be likely to raise interest rates to try and cool down an overheating economy. That possibility is also being reflected in the bond markets, as you can see in our second chart, which plots the yield or interest rate offered by the U.S. 10-year Treasury bond. As you can see, that interest rate has risen from around 0.5% in August 2020 to as high as 1.5% in the last week. That matters for two reasons. Firstly, because the yield of these benchmark bonds also reflects the likely cost of U.S. government borrowings. The U.S. runs what's known as a deficit, which means that it spends more money than it generates, and to bridge the shortfall, the government borrows money in the bond markets. Right now, and over the medium term, the amount of money that the government will borrow is rising, as is the total national debt, which is approaching $28 trillion. Higher interest makes this debt burden more expensive to finance, and makes new borrowing dearer too. Of course, if the U.S. economy does rebound sharply over the next 2 to 3 years, then it will generate a significant amount of money, which could help to offset this increased debt burden. However, the bond market is feeling cautious rather than optimistic about the future at the moment. Why have these concerns upset equity markets? Well, simply because equities have done very well out of low interest rates and other Federal Reserve policies designed to support the markets. If those supportive policies were to change, for example, if the Fed withdrew QE and stopped printing money to buy securities with, or even raised U.S. interest rates, then that would take away one of the biggest props for U.S. equity markets. Technology stocks have been the best performers in recent times, and as such, it's those that are the first to suffer. That's all we have time for this week. Before you make any investment decisions, please ensure you do your own due diligence. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.